Stock markets rallied again today, partly on that surprisingly good jobs data. As investor optimism continues to push indices to new records, it may be time to add a little insurance to your portfolio, just in case another correction is in the cards. David Kaufman is the president of Westcourt Capital. Great to have you here.
Good to be back.
I think this is a well-timed conversation because we know that people who've been on the sidelines tend to get into the markets when they hit new highs, because that's just how we roll. So we get in and then we're almost guaranteed to see some downside. In order to protect against those declines, what are you recommending?
The best way to protect it, first you have to decide, am I trying to protect against a little bit of loss or a lot of loss? And most people would say, look, I'm in the markets, I accept the fact that there's some volatility, but I want to protect against the big loss. And that's done, it sounds complicated, and it is somewhat complicated, through a dynamic put strategy. Essentially what you're doing, to use insurance parlance, is you're buying insurance against catastrophic loss. So the premium is what it costs you to buy puts against your equity portfolio, and the deductible is the spread between where the market price is now for those equities and where the strike price is. And the larger the deductible, like all insurance, the cheaper the insurance.
Where does fixed income fit into your strategy? Because many people think in terms of long-term investing, some portion of bonds is not a bad idea to provide stability and income.
That's a very interesting question, Kevin. And one of the first things that I would point out is that last week, I don't know if you heard, that UBS now classified long bond portfolios as aggressive because many people, point out that fixed income portfolios are loaded with risk because of the potential for diminution of risk, of value when interest rates eventually rise. So, I mean, I guess that the way to avoid risk in that is to lower the exposure that you have in your long bond portfolio, whereas the dynamic put options that I'm talking about really apply into the equity side.
Okay, break this down for us. If we buy into the dynamic put option, this kind of you're going to limit your downside and your upside, presumably, when you do this. What's the easiest way to achieve it?
Yeah, the fastest and easiest way is to do it through an ETF, because most people are not options licensed on their own. Luckily, we have two ETFs, one for the Canadian market and one for the U.S. market, both from Horizons. One is the HUT and one is the HUS. And so that, as you can see here, you can either do it yourself, you can try and get, you can certainly use an options licensed advisor to do it, which is available in Canada, or you can go through these ETFs. And what they do is they give you broad market exposure to either the Canadian or the American market. They actually sell a few calls in order to buy a few puts. They will not help you in a small decline, and they certainly will cost you a little bit on the way up. But in a really large decline, when you need the insurance most, it'll be there to save you.
In fact, we have charts, I think, showing how the index tracks against these ETFs, which I think is worth a look, because this looks more complicated than it is. But what you're saying is that you will never be as high as the market's high, but you will not be as low as the market's low. So if the market corrects a tiny little bit, that's not going to affect you. But if it plummets, you're going to hold at this level.
That's exactly what you would expect to see here in 6 months, that when the broader market is really down, you're not that much down. But when the broader market is on a bull run, as it is right now, you're not going to quite keep up. But a lot of people will give up that upside to protect on the downside.
Speaking about ETFs, I'm just wondering what your thoughts are on this market. There seems to be a proliferation of them. Many of them, as much as a third, don't make money for their issuers. Do you think there's going to be a consolidation that we'll see less next year than are in the market now?
I think that what you'll see, there'll be some sort of organic consolidation, because like any other kind of fund, not every idea works. And you have seen a proliferation of actively managed ETFs, which are essentially like discount mutual funds. And not all those managers are good, and not all those strategies will work in different markets. And so the market will decide which are popular and which are not, because to your point, they don't issue the ETFs to lose money. And so if they don't have enough volume, you'll see, as I said, organically, some of them will live and some of them will die.
Now, one of the reasons, of course, that markets are doing well is because corporate profits are strong. And so there is some fundamental underpinning here. When you think of what might make a market turn, it isn't just that they're hitting new highs. What are some of the reasons that we might look to see a sizable correction?
Some of those are things that we can predict, like, the Fed deciding all of a sudden, deciding all of a sudden to stop pumping money into the economy, or pumping liquidity into the economy. But the reason they call these black swan strategies is precisely because we don't know. There could be a terrorist attack tomorrow. There could be something that happens in Europe tomorrow. They could elect the wrong pope next week. Any of these things could happen, and the markets can react often quite viscerally, quite strongly and unpredictably, and that's exactly when you want that protection.
Time for some insurance. David, great to have you here.
Thank you.
David Kaufman, president of Westcourt Capital.